There's this hidden paradox that's shaking the very foundations of our financial system. It's the real reason we're seeing all this chaos, from stocks all the way to crypto. We're going to peel this back layer by layer and figure out what is really going on. Let's dive in. So it all starts with a question you've probably been asking yourself when you look at your own investments. Why is everything so, crazy right now? One day the market's flying high, the next it's in a nosedive. It just feels totally unpredictable. But here's the thing. This volatility isn't random. Not at all. It's actually a symptom of a much, much deeper stress in the system. And that stress, it always shows up first in the markets that are easiest to get in and out of in a hurry, the most liquid assets. A perfect example is Bitcoin. Because it trades 24/7 all over the world, it acts like a kind of canary in the coal mine. It soaks up global risk and reacts way faster than traditional markets. So what happens there is often a little sneak preview of what's coming for everything else. Okay, so let's get into the mechanics of what's causing all this volatility. We are watching a massive deleveraging event unfold. Now, that's just a fancy way of saying a rapid unwinding of debt that's literally forcing money to be pulled out of the markets. But what's the trigger? What's setting this whole machine in motion? Well, a huge piece of the puzzle is actually Japan. For decades, their interest rates were near zero, which basically made them the world's go-to source for cheap money. But now they're facing an impossible choice. On one hand, they can defend their currency, the yen, by raising interest rates, but that would make their gigantic mountain of debt incredibly expensive and set off a global deleveraging bomb. Or they can protect their bond market by keeping rates low, but that risks absolutely crushing the yen. It's a lose-lose situation, and the stress from that choice is spilling out everywhere. So that deleveraging gets magnified, it gets amplified by something called synthetic supply. I know, it sounds super complicated, but trust me, a simple analogy with a Pikachu trading card makes it all click into place. All right, so picture this. First, Wall Street takes a single, real, physical Pikachu card. They lock it away in a vault, and then they create a financial product, like an ETF. Suddenly, hundreds, maybe thousands of people can trade little shares that represent ownership of that one card, getting exposure to its price without ever having to touch it. But they don't stop there. Oh no. Next, they build even more layers on top of that. They create futures contracts so you can bet on the card's price next month. They create options so you can bet on its upside or its downside. They create swaps to let people go long or short with a ton of leverage. And none of this, absolutely none of it, requires owning the actual card. And the result is just wild. You've got one physical card that might be worth, say, $1,000. But there could be over $100,000 worth of value being traded through these paper contracts. At that point, the price isn't being driven by the physical card anymore. It's being controlled by this massive, almost imaginary synthetic supply of paper claims. Now, this isn't just some funny little thought experiment. This is exactly what's happened to major assets like gold, silver, and yes, Bitcoin. Their short-term prices are now completely dominated by these paper markets, where the supply of contracts has no connection to physical reality. But, even synthetic supply and deleveraging are just the mechanics. They're symptoms. To find the real root cause, we have to peel back yet another layer and look at the 80-year-old economic system we're all living inside of. It was built on a set of assumptions that, frankly, just aren't true anymore. See, our global economy is a debt-based system. That means it needs to borrow from the future in order to grow today. And for that whole machine to run smoothly, it has always relied on a few key pillars: a constantly growing population of workers, cheap money to fuel all the borrowing, and a basic level of global cooperation. But what happens when those pillars start to crumble? And this brings us to the absolute heart of the problem. This is the core conflict that's driving all the volatility we see today. We are caught in a massive, fundamental paradox between the economic system we inherited from the past and the technological future we are building at lightning speed. On one side of this paradox, you have the actual architects of our AI future, people like the CEO of Anthropic telling us point blank that a huge wave of white-collar job disruption isn't decades away, it's coming in the next 1 to 5 years. And this isn't some future prediction. The stress is already showing up in the numbers. Job cuts just this past January hit their highest level since the absolute depths of the 2009 financial crisis. The job market is already slowing down, and that's before AI's full impact has even been felt. So here it is, the paradox in its simplest form. The old debt-based system we have needs more humans working, earning, and borrowing money to pay for all the promises we made in the past. But the AI future that the markets are so excited about assumes far fewer humans will be needed for work, which means less income and less borrowing. These two realities cannot exist at the same time. Something has to give. So when the very engine of your economy is in direct conflict with the future, and on top of that, trust between countries is fading fast, well, you're forced to ask the most basic, fundamental question of all. For decades, we lived in a pretty predictable world. You could call it a rules-based order. Everybody knew their role, right? The US printed the world's money, China built everything, Europe bought everything, and Japan lent everyone the cash to do it. That predictability is what allowed all this debt to build up relatively safely. There was a feeling of stability. But that order is now fracturing. It's breaking apart. Nations are scrambling to restructure their supply chains. Old friendships are being questioned, and trade is being used as a weapon. The predictability that was the system's safety net, it's gone. And with it, the trust that held global finance together is evaporating. In this new, deeply uncertain world, everyone from central banks down to regular investors is scrambling to figure out what is truly safe. What is real money anymore? Is it still US government debt? Is it physical gold? Maybe it's a new currency or a commodity or some kind of digital asset. The truth is, nobody knows for sure. So the big takeaway here is this. The jarring volatility you see in the markets isn't just random noise. It's the symptom of a system that's grappling with a paradox it cannot solve. And it's forcing all of us to confront one final, profound question. In this strange new future that we're all walking into, what will we all agree has value?